Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, October 11th, 5:40 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a correction. You can see over here in the trend gauge, the three time frames that we track, all showing bearish/downtrend. That means the five major indexes that we review in these videos are all trending below their short-term 21-day exponential moving average, below their medium-term 50-day moving average, and most importantly, below their long-term 200-day moving average. Leadership still neutral at best, stocks holding up. One in particular sector that we're going to discuss today holding up better than a lot of the others, but has now had a pullback for a couple days, and that might be presenting attractive entry points. I'm talking about the oil and gas sector. Neutral with the arrow pointing toward red because of the overall market conditions. So what happened today? News, a lot of news, and that resulted in a volatile trend up and trend down. Really, it was down, up, down, and then a bounce at the end of the day. A lot of volatility. Something came up that put a big scare into the markets, and it could be just the tip of the iceberg. We'll talk about that. Not trying to scare anybody, just present the facts and the market reaction to those facts. So we ended up mixed on the indexes today. Our growth composite, the G6, ended up down 0.95%. S&P 500 gapped down 1% at the open. Got redder in the morning, was looking like in fact, it undercut, made new correction lows. Very strong rally, late morning, early afternoon. Some news came out, complete reversal. We'll take a look at the charts here momentarily and you'll see, but a very volatile day. NASDAQ 100 down 1.37%. Dow Jones Industrial Average was positive, led by Amgen, which got a big upgrade. Mid caps and small caps also finished slightly positive. Global diversified 60/40 stock bond index down 0.64%. We continue to be all in cash here. Our GROTECTION flagship portfolio all in cash, so unchanged on the day. We'll go through the tail of the tape and then dig into some gas and oil charts. 27 of them I've got to show of varying degrees of health and attractiveness. We'll get to that momentarily. First, let's get into why we do what we do here at Revere. And look what popped up there. My favorite chart. This is why we make capital protection, capital preservation, risk management number one. Our number one job here. You control the downside, then you can compound from a much higher asset base than if you live through a significant drawdown. And net, you sleep better, and your returns are as good, if not better, than if you were in a broad market index, and certainly a diversified 60/40 stock and bond, as bonds have been really bad this year. That's supposed to be the diversifier, and that really gets to the heart of the scare that went into the markets today. We'll talk about that in a minute, but this is the last 13 bear markets going back to 1968. The average of the worst of them down 44.5%. That means you need 80% to get back to even. Imagine going into retirement and all of a sudden you've got 44.5% less than you thought you were going to have when you retired. And this actually needs to be changed to October of 2022 as we made new lows today, top to bottom. So ticking up toward 26%. And enough fear in the markets and enough news pending. Certainly no guarantee that it's going lower, but there's a lot going on. You could get positive or negative big reactions from PPI and CPI on Wednesday and Thursday, also from the Fed minutes, and then we'll talk about the issue with England shortly. So that's why we protect capital. It's pretty plain and simple. We're not fear mongers. We participate in the upside, protect in the downside. Here's an example of the upside. We participated in October, November, riding the markets higher when they're trending above their short-term 21-day, that's the green line, their medium-term 50-day, that's the red line, the long-term black line, that's the 200-day. We're as long as we are comfortable being in that situation, the markets start to roll over. Our stops will take us out. Sometimes there'll be false breakouts. That's part of investing. Sometimes it'll be worse than just a pullback, and then the slopes of the moving averages start to roll over, and that's when we get even more defensive. And then if we break the black line, the 200-day moving average, I just showed the numbers. All of those severe bear markets occur under the 200-day moving average. Sometimes you bounce around the 200-day. There'll be fits and starts, but the key day this year was April 21st when we tried to get back above the 200-day, failed. The slope of the moving average rolled over, and then we had a big leg down here tied to Fed policy and inflation numbers. Strong bounce from June into mid-August. We participated in this, and then we rolled over when we ran into the big bad downtrending 200-day moving average. We've got a significant edge over versus the S&P 500 this year, and even versus a diversified stock and bond index, which isn't doing much better. It is truly the death of the 60/40 index when you've got stocks going down and rising interest rates. So getting out of the way, participating in uptrends, you're interested in this approach, common sense to us, it's what you do in every other aspect of your life. Reach out to me, don@revereasset.com. You can also email my partner, Dan Stewart, dan@revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. So that's the S&P 500, and you can see today, we're actually, I don't consider this to be down 5 straight days, even though we finished red. I really consider with the break being down day 1, and then today down day 3, making lower lows. I consider these two to be consolidation days within this uptrend before the market decided that it wasn't going to move higher out of the consolidation, but move lower. So lower lows, really 5 down days, but 3 big down days. And that started with the gap down because of the too strong jobs report on Friday, followed through Monday and Tuesday to the downside, making lower lows. That's the S&P 500. Let's look at the NASDAQ 100. Same situation, lower lows, ran into the 21-day moving average. That's a declining green line. That was our what we were looking for was a move higher out of that, and we certainly didn't get it after the 2-day. When you start a trend and then you consolidate, the consolidation should revolve in the direction of that trend. Yes, I know the bigger trend was down, but this was a counter trend rally. The expectation was that it would go higher. The expectation was certainly foiled. It's okay to be wrong. It's not okay to stay wrong. We cleared everything out on Friday. And then what was a positive stochastic hook going into all of last week into Friday, reversed lower and now has continued lower as we approach back to oversold conditions across all of the indexes. Let's look at the Dow Jones Industrial Average, not as bad as the NASDAQ and the S&P. In fact, it hasn't made lower lows relative to 2 weeks ago. Let's go to mid-caps MDY. Still above this key 400 level, again, higher highs, not lower lows versus this movement the last 2 weeks ago. And then let's go to IWM, small caps, hasn't made lower lows either, and finished positive today along with the Dow and with the mid caps. G6, not looking good. They rolled over. I showed that last night. Let's talk about some stocks that are holding up okay, a couple of them, and then we'll go into the oils. HLIT holding up. This is, to me, the best looking chart in the market. It's thin. We're looking at some models in-house on how we can sneak in, even with our the fact that we manage 120 million makes it more difficult, but we would hold a smaller size, but we're looking at low risk ways to get in if we decide that we've got a low risk entry, and that would include the market showing somewhat of an improvement. Another one that had been acting pretty well, DGII, not so well after the pullback the last 3 days, although it did hold that 35 level. This is another one that's on the thin side. CEG, a stock that we stopped out of last week, broke the 21, but is still above the 50-day moving average today. CCJ broke down last week, bounced at the 200-day moving average as uranium had a good day. And really, it's tough to get anything going or anything consistent. A lot of the stocks that were holding up best, let's look at AEHR. That had a big move on earnings, gave it back, bounced, gave more of it back today, still holding above the 50-day moving average. This is what you get when you're in a bear market. Now let's go to an intraday chart of the S&P 500, and we'll talk about what happened today, and we'll take a look at the tail of the tape. So yes, we're in a correction. We've got the macro headwinds as well as technical headwinds with our stochastic hookup failing. Put call not elevated at all. VIX is high, 33.63. Fear and greed dropped 2 more points to 18. We're operating under the bear case. So today, mixed news. Fed Loretta Mester came out, Mester, I don't know what it is, came out and said no progress versus inflation. We need to worry about not being strong enough. And that was early, and the markets were down on that. Then the New York Fed came out and said, hey, we had a historic drop in September household spending. This is exactly what the Fed wants to see. They need the demand to go away, or at least get in line with some of the supply. And that should bring inflation down. So this was a bit of good news, and the market rallied on that. And then in the afternoon, and tell me if you think you know where this happened. Okay, I'll show you. 2:45 p.m. The head of the Bank of England. Now, if you've been listening to us, you know the Bank of England had to step in to prop up their bond markets last week. Well, the pension funds, and pensions are massive in Europe and in England. The head of the Bank of England, the pensioners thought that they asked till the end of the month for the Bank of England to support so they could reposition themselves and sell some of the bonds, which would be bought by the Bank of England because they reinstated quantitative easing because of problems they're having with sovereign debt. Well, anyway, the Bank of England's head told the pensions, you guys have 3 days to sell your bonds. We're done in 3 days. We're done at the end of the week. And that put a big scare into the market. When you've got something that everybody's trying to sell and no supply for it, how supportive can the Bank of England actually be? You see the gap down, 35.68, made a new low. We bounced. This was a very strong bounce. Had me thinking we were in an undercut and reclaim situation. Wouldn't have surprised me at all, because if you look down here, this was a very big support area around this 3,700. This big really it's 35.50 to 36.14. There's several different reasons why there's support, but the bottom line is that it's a lot of support. We went down to 35.68 and bounced. Because it's the 200-week moving average, negative 25% year to date, negative 25% off of the recent high, or the early January high and the early January close. It's a big area of support, along with the fact that it was the November 2020 breakout at 35.50 to 35.88. Big reason for buyers to come in there, not to mention the elevated VIX, and that happened. So I know we had CPI pending. I was considering dipping a toe into the market. We looked at this pullback, didn't want to do it when we were extended. In other words, with the stochastic up high where it is, we're looking for a lower risk entry. I wasn't looking for a waterfall, and that's what we got. And look at the volume compared to the volume while we were consolidating this move up in the morning. This is selling. This is people wanting to get out. Maybe it was an overreaction. We stopped going down again at this 35.68 area, so that's very strong support right now, 35.68 on the S&P 500, and we bounced and closed back inside this whole range here, 35.50 to 36.14, as we closed at 35.89. Really, PPI in the morning and the minutes and CPI are really going to tell the tale of the reaction to this. But if this panic carries over to European bonds, again, we've been saying it for a while, this stock bond correlation is breaking risk models worldwide. Pension funds hold a bunch of bonds. That's supposed to be their safety net in case stocks underperform, but it's not doing the job, and it's breaking risk models, and it's definitely something to be concerned about. Nobody thought the financial crisis would go on as long as it has. we don't know how long this is going to go, but there's never one cockroach. That's something that we do know. So moving on to what we did today. So this was the Bank of England telling pensions they had 3 days to the end of the week. We went from 2 days down to 3 days down. Overnight, we did an undercut and rally. Then we did the undercut and rally again midday. Then we did the undercut and rally again at the end of the day. So that 35.68 area is pretty strong. I want to make a correction. I said CPI was on Wednesday. It's not. It's on Thursday. Tomorrow is PPI in the morning and FOMC minutes. PPI isn't given as big a weight as CPI because PPI may or may not be passed on to the end consumer, but I mean, it's important enough by itself. Any good numbers, the market is really itching to rally, is what I feel, based on the way that we're constantly bouncing. But then again, that just might be the way bear markets destroy not only bears but bulls also. But any positive news, the market looks to rally. And it's just a matter of weighing the positive news and the negative news and the reaction to see where we end up. So my expectations were negative coming in. We did the down, up thing. Volatility, that's pretty negative. We did undercut and reclaim these new support areas that I have in here, this fib on the NASDAQ 100, this big support area. It's really 35.55 or 30. It's really 35.50 to 36.14. Here's the intraday action and the ranges. Bonds were up today, which means interest rates took a little bit of a tick back. Let's take a look at 0TNX, the 10-year. You can see, well, that's showing, that's the TLT. That's odd. Let's take a look at TLT. TLT was up, which means rates were down, but the TNX is showing that they were down. Let me look at IEF. A little bit of a disconnect here between the ETF and what's showing on the 0TNX. That may not be updated. Well, anyway, we're near the top of the range. I was expecting to see that be a little bit lower. Anyway, where were we here? Bonds. Okay, positive today were defensive sectors. Second day in a row that defensive sectors were much stronger than growth sectors, with staples, healthcare, and real estate leading today. Retail, biotech, gold stocks led early but turned negative. That doesn't belong in there. And uranium was strong today on the downside. The dollar ended up actually being neutral today, just up a tick. It was all over the place with was going on in the afternoon with the news out of England. On the downside, definitely SOX, IGV, oils, and coal. Focus coming in, we're still looking to isolate intraday relative strength. And watch the indexes for the range. We did get that undercut and recover, and then undercut again and hold. Still in all cash, no trade. So bottom line, volatile up-down trends. Bank of England and UK bonds spark fear. This is the big support area, 35.50 to 36.14, that needs to hold, or the next level down is at 35.05. And if you want a specific number, it's today's low, 35.68. Which is right around in that area. So let's go to oil stocks now, which is going to be the featured sector for today. I keep what I consider some leading fundamental oils in a list, and let's start off. These are sorted by 3-month relative strength. Denbury, there were some buyout rumors about it yesterday. That's the reason for the big move up inside day today. Matador, you're going to see a familiar pattern here with most of these. The pattern is going to be relative strength near highs, price near highs, a harsh sell-off 3-4 weeks ago, followed by a strong bounce over the past 2 weeks, and then a 2 to 3 day pullback into either the 80 MA, the 21 EMA, or the weaker ones, the 50-day moving average. Some of them, in fact, are beneath the 50-day moving average. Schlumberger, this is the strongest oil sector Stock, I was actually surprised how strong this chart looked because OIH really doesn't look that good, but you can see the nice move up there. In fact, it had definite accumulation shown during this most recent move up, followed by very light volume on the 2-day pullback. Devon Energy, 3-day pullback, sitting on the 80 MA. FANG, this is Diamondback, 2-day pullback, the usual pattern. PXD, this is a nice ETF. This is for exploration and production. There's two. There's XOP and then there's PXD. This one acting a little bit better. Look at the volume and the number of positive days higher on this move off the bottom by these oil stocks. Dino or Dino, if you're a fan of the Flintstones, you can see this pulling back. This is actually a failed breakout. But all breakouts fail in a market like this. So failed breakout and now a 5-day pullback. This was a leader. Really still looking fine, undercut and reclaim the 21 today. LNG near the top of the buy list if we take a plunge into oils. And remember, oils are probably the least the single sector that does not stay in sync with the S&P 500. You can buy oils when they're acting good, and they're a smaller percentage of the S&P, so the index doesn't move them, and they don't move the index, so they can zig very clearly while the index is zagging. PXC, this is an oil and gas. Actually, it's more gas focused. 3-bar pullback. Right to the 21-day exponential moving average. ExxonMobil, fantastic move off the 200-day moving average. 3-day pullback, big volume up, light volume pullback. PSX, big move up, lighter volume pullback. Note the volume patterns. I think they're important. XOP, here's your other explorer and producer. 3-day pullback to the 21 EMA. Halliburton, much weaker than Schlumberger. Usually these two are absolutely the dominators in the OIH ETF, but right now Schlumberger acting much better than Halliburton. Here's OIH. You can see how that's not even above its 200-day moving average. That's why I was surprised at how strong the Schlumberger chart was. XLE, this is dominated by Exxon and Chevron. Pullback right into the 21. GTLS, oil and gas supplier, pullback, a little more volatile than the usual suspects. Bounced at the 21 today. FCG, this is the ETF that is more gas focused, first trust natural gas. 3-day pullback right into the 21. Here's Chevron, weaker than Exxon, but still a decent chart. Here's Oxy, not sure. I mean, this is Buffett constantly buying this. That's what all these pluses are. Is he's an insider and his insider buying. Pretty harsh pullback over the last 3 days and not preferable volume patterns. I don't know if I don't really know. You would think that there'd be a Buffett bid underneath this and it would be one of the relative strength leaders, but it really hasn't over the last 3 days. Chesapeake, harsh pullback below the 50-day moving average, harsher than normal. CLR just going sideways over the last 5-6 days. They've got a buyout offer from the majority shareholder that I think they're waiting to do a vote on or something, so that may be keeping a bid under this one. USO, this is oil, the commodity. It underperforms the /CL futures because of contango, but you can see the strong move up and now pulling back. Valero's a refiner, 3 days back below the 50. EQT, these next two, Michael talked about them in his review, but they haven't really been acting well lately, but they are, which is a little bit of a surprise because they are really tied closely to the nat gas supplier dynamic to Europe. Same thing with NFE, bounced at the 200-day moving average, underperforming. RRC, Range Resources, broke below the 200, so here's another one that is underperforming. Was an outperformer back here when it formed its cup and handle, which broke out and then failed. And then finally, UNG, this is nat gas. This is the U.S. nat gas. There's no ETF that plays European nat gas futures. It would be much higher and then much nicer chart on this than it would be than this chart is, and that is 27 tickers related to the oil and gas sectors, a little bit of everything in there for everybody, and that's going to wrap it. So as always, love to hear from you. Don at revereasset.com or Dan at revereasset.com, or the phone is 855 Real Wealth. Remember, it's not how much you make in the markets, it's how much you can keep. That's particularly critical when you look at this chart of returns, and then you look at this chart of the S&P 500, and you say, hey, where are we relative to this black line, the 200-day long-term moving average, which, by the way, is where all of these bear markets occur. And, if you're in your 30s, you don't have to worry about it as much. If you're in your 40s, maybe a little bit more. If you're approaching retirement, you got to think about this. No question about it. What good is a 300% return if it's followed up by a 50% loss? That means you only gained 150%. It doesn't mean that you go from 300 to 250. It means you gave up half of all of your gains. That's the math behind it, and that's why it's so critical to protect it when your nest egg is at its all-time high. If you have any questions about that, reach out to me. So, wrapping up Tuesday, October 11th, 26 minutes later, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.